I'm an economist, and therefore I'm very happy for inviting me here to this conference. And I'm teaching at a business school, and therefore I'm interested in the consequences of this new transparency world on decision making of managers and investors, and therefore I would like to talk about the consequences of this new transparency world. And I will try to give mainly a brief overview on empirical evidence regarding these effects. But first of all, I would like to start with some theoretical background. So what are the effects we would expect from this new transparency world? I think it's helpful to distinguish two main different effects. On the one hand, we have effects on the behavioral response of managers, and the effects are mainly on tax avoidance or tax payments of these multinational firms, if there's this new transparency world. On the other hand, there might be effects on the behavioral response of investors and customers, and that should have an effect on firm value. And what are the main drivers? I don't know if it's a complete list here, but it's my ideas about this topic. I think first of all we could have direct tax costs. If there's additional information for tax auditors, they can better enforce the tax law, they can collect more taxes, and managers might anticipate this new information environment, and therefore the managers can adjust their tax planning strategies. And there might be also additional tax payments in the future, because as a consequence of this new information environment, there might be new regulation in the future. For example, in UK, there was in 2012 this discussion about Starbucks and Google, and then UK invented this what is called a divided profit tax, a new tax regarding branches and other issues. So there might be new regulation. Then there might be reputational costs. We discussed about this in the other presentations before. If customers can evaluate the tax avoidance behavior of a multinational firm, they might be concerned about the fairness of this firm, and therefore there might be reputational consequences, and managers might anticipate this effect, and this should also lead to less tax avoidance and a reduction of firm value, because maybe sales might go down. Then there might be proprietary costs. So if competitors have better information, maybe on a country-by-country level, about the activity of one of the competitors, that should have an effect. Maybe on the price setting of the firm in the future. If the customer now there's a high profit margin from business with this firm, there will be a tougher bargaining process, for example. That should have an effect on firm value. So many effects negative on tax avoidance and also on firm value, but we can also expect some benefits of this additional tax transparency. Especially investors have better access to information about the tax planning effort of a firm, so that could put some pressure on tax managers of multinational firms to do more tax avoidance, to do smarter tax avoidance, especially if risk assessment is possible. Typically, we have litigation risk associated with certain tax planning strategies, and if a tax manager is smart, he will engage in advanced tax ruling, advanced pricing agreements, and if a firm can disclose this information, that might also have a positive effect on the assessment by investors and also on firm value. So from a theoretical point, it's not clear whether it should be negative effects on tax avoidance or positive effects on tax avoidance, and also if there are some effects on firm value. So what is the empirical evidence about? I would like to talk about these two topics. First of all, I would like to present some evidence about the effect of tax transparency on tax avoidance of multinational firms, and thereafter I would like to present some evidence about the consequences of tax transparency on firm value, so investorial response of investors. What is the challenge? The main challenge for empirical research is that we would like to evaluate a new transparency world. We're discussing about these new measures, but we need data and past events, and therefore it's a challenge to evaluate this new world at this point of time. But there are some studies, and the idea is to identify some past events of changing transparency, and you need also a setting where you can clearly identify some causal effects. Sometimes there is a new transparency, there's a transparency shock in tax reform, but it's associated with a lot of other measures like a new tax rate, changing in the tax base, and then it's not clear what is the driver of some effect. And therefore, I would like to present you some settings when researchers, mainly from economics, have identified some effects. First of all, I would like to refer to, it's a little bit, I don't know, so it's better. I would like to refer to the question whether the information towards the tax administration has an effect. If you have additional information for the tax authority, does it have an effect on tax avoidance? The two studies I have in mind. First of all, there's a study using European firm data. It's a study by Nadine Riedel, Theresa Lose, two German researchers, and they use Amadeus data. There's a firm-level database. All subsidiaries of European firms are included in this database, and they also consider the introduction of transfer pricing documentation requirements in Europe during the last 2 decades. And they find that these new documentation requirements had an effect on the profit-shifting behavior of multinational firms in Europe. More precisely, normally we find a negative effect of the host country tax rate on reported profit of a certain subsidiary, and they show that this effect was reduced by the introduction of these new transfer pricing documentation requirements. And there's another study also confirming this relationship. Information available to the tax authorities and reduced tax avoidance. It's a US study, and this study refers to, we would call it a country-by-country reporting, and in the US there is actually such a country-by-country reporting in place. It was introduced in 2004. It's called Schedule M3, and all US firms are obliged to submit some information about their foreign subsidiaries included in the Schedule M3 to the IRS, to the US tax authority. And these researchers here show that this new obligation was associated with increasing effective tax rate, with increasing effective tax payments of US multinational firms. Therefore, we can answer this question that there is an effect of additional information provided to the tax authorities limiting tax avoidance. What's about additional transparency that allows evaluation by customers, investors, or the general public, this is discussed at the moment, especially at the European level. This country-by-country reporting, should it be available to the public? There is some evidence from surveys among managers multinational, mainly here in this study I show here. These are US managers. It's a survey carried out in, I think, 2012. And these managers, it was CFOs and tax executives of US firms. 70% of these managers rate reputational concerns as very important when they discuss a new tax measure or a new tax strategy. So from this survey evidence, we can conclude managers consider these potential and anticipate these reputational effects. But it might be, it's only a survey, it might be cheap talk. Yeah? And therefore, other studies try to find out whether this information environment has an effect on the tax avoidance that is realized, that is reported by multinational firms. And all of these I would like to refer to these 3 studies here. And these 3 studies, they always consider some information, a change in the information environment about the worldwide group structure of multinational firms. The first study here by Dirang, Hopes and Wild is published in the top accounting journal, and this study considers UK. UK firms, and in UK there's a rule that firms have to report carefully a list of all of their foreign subsidiaries in the appendix of the financial accounts. That's the UK law, and in the past nobody really cares about this rule. So UK firms report maybe 5 or 7 of their foreign subsidiaries, but they had 200 or so. But since 2010, there was a lot of rumor because of NGOs, and these NGOs put some pressure on, and therefore this rule is now enforced very strictly. And as a consequence of this transparency shock to UK firms, these researchers show that the effective tax rates of these UK firms went up by about 2.7 percentage points on average. So it's, I think, a significant effect, and this effect was stronger for firms which were more exposed to this transparency shock, because due to a higher share of foreign subsidiaries in tax havens. So one study confirming this relationship a little bit. Another study used a different direction of transparency shock. It was a reduction of transparency for US firms. Until 1998, US firms had to disclose geographically their earnings, the earnings at a geographical level. It was part of the financial reporting obligations, and then this reporting disclosure became only voluntary. Yeah? So it was abolished, and many firms changed reporting. They maybe reported earnings on a business line level and not on a geographical level, and others did not change. Other firms did not change their reporting behavior, and these researchers here, they compared the tax avoidance behavior of these 2 types of firms, and they show that the firms that had changed their reporting on a worldwide about their worldwide earnings could reduce or reduced their effective tax levels by about, and that's a huge effect, 4 to 5 percentage points in terms of the effective tax rate. Yeah? And so it seems to be a significant effect. And I also have in paper a study in this field, and together with 2 other co-authors, we consider a very recent phenomenon of US firms, another reduction of transparency, because US firms are actually obliged to report a list of all their significant subsidiaries as an appendix to, this Exhibit 21 appendix of their SEC filings. If you are a public firm in the US, you are obliged to report this list. But between 2010 and 2014, we identified more than 250 firms that significantly reduced this list. So they dropped more than 50% of the foreign subsidiaries from this list. And maybe let me briefly illustrate our idea here. Take, for example, the case of Oracle, and these are the numbers of foreign subsidiaries reported in Exhibit 21 of Oracle. And until 2010, there are about 300 foreign subsidiaries in this list. There's name and the host country. So you have a rough idea about the worldwide business structure of Oracle. And then suddenly in 2011, there was no change in the reporting rules. The number was significantly reduced to 2 foreign subsidiaries, which are both located in Ireland. Yeah? And in 2012, the number increased a little bit, but there was a takeover. Of Sun Microsystems by Oracle, and maybe they bought 3 foreign subsidiaries. And the question is there a relationship between this public disclosure change and tax avoidance? And the numbers of Oracle suggest that this is the case. Yeah? We find a significant drop of the foreign ETR of Oracle. That might be, but might be only a single case. And therefore, in the next step, we analyzed all the 250 US companies, and that had also changed the number of foreign subsidiaries in this list. And yeah, first of all, we find that there's a higher probability of changing Exhibit 21 if the firm has a smaller share of fixed asset. That means it has a higher share of intangible assets, and if a firm has a higher R&D, higher share of amount of R&D expenditures, and both characteristics are, this is shown in other studies, are associated with international tax planning opportunities, with profit shifting. These are income mobile firms. Yeah? So that is our first indication that there might be some tax reasons to change reporting here in terms of Exhibit 21. And in the second step, we analyzed whether there's also a change in the effective tax levels, effective tax rates of these firms compared to the other firms that did not change their disclosure in terms of Exhibit 21. And in fact, we find there was a change. The foreign ETR of these firms, went down by about 3 percentage points in terms of the foreign ETR, and in terms of the worldwide overall GAAP ETR by about 2 percentage points. So we conclude that there seems to be some relationship between going dark and avoiding more taxes. Well, we discuss about country-by-country reporting at the moment, and there is one case where this country-by-country reporting is still available to the public. That is in the case of European multinational banks. There was this financial transparency was introduced by the Capital Requirement Directive 4 in 2030, and there's a typo on the slide here that became effective in 2040. And yeah, this is work in progress, but we have preliminary results showing that there was an effect also on the effective tax levels reported by multinational banks, European banks, which were treated by this new transparency shock. Now they have to report on a country-by-country level key performance indicators. And we find that these multinational banks report higher effective tax levels in the aftermath after this transparency shock occurred, compared to domestic banks, which were not treated. compared to insurance companies, which were not treated but might be very similar, and also compared to multinational firms from other industries, which might be affected by this BEPS discussion. Yeah? There might be change in the international tax planning environment, but which were not treated by these transparency shocks. So these preliminary results suggest that also publicly available country reporting could have an effect on a limiting effect on tax avoidance. So this is one conclusion, and the other topic I would like to mention is the effect on firm value. Yeah, what is the effect of tax avoidance on firm value? Typically, additional tax avoidance should increase firm value. Yeah? That's the interest of the shareholders. If you pay less taxes, there's more profit for the investors. But there are limits, especially if tax avoidance is associated with high litigation risks. Yeah? Then, of course, the investors would like to limit this tax planning effort. So the question is, how does additional disclosure about this tax avoidance affects firm value? There is a basic disclosure. We have this effective tax rates. We have some information in the financial accounts about the total effective tax expenditures of multinational firms. But if you have additional information, what should be the effect? There could be a positive effect. Investors are better informed. They have more insight, and therefore they invest more in this company. On the other hand, and especially if it comes to risk assessment, investors might reward additional information if a firm can disclose that they are very smart in terms of tax planning, if they have, for example, many advanced pricing agreements, so tax avoidance is associated with less litigation risk in the future. That would be a good news for investors, and so additional information could have a positive effect. On the other hand, of course, there are these negative effects if you have additional tax payments, or if there are reputational consequences. For example, if you have a boycott by customers, it's as a consequence should be negative effect. Yeah, what's the evidence? It's difficult, of course, to analyze, to identify here some effects. There are some anecdotal evidence. For example, the Starbucks case, which was mentioned in one of the presentations before. There is evidence that I think for 2 or 3 days, the UK citizens, they drank no coffee, and after 3 days they became thirsty, and then they returned to Starbucks. So there's a lot of evidence that these effects are only short term. So we should be very concerned about any reputational effects. Then there are 2 studies using US data about US multinationals which were involved in tax shelters, so very aggressive form, maybe illegal forms of tax avoidance. These data are mainly collected from the courts. Yeah? If there's a judgment about some tax planning structure, then this information is publicly available. And but the problem is this is a very aggressive form. It's illegal, maybe, so associated with enhanced reputational effects, and also often associated with tax penalties or back taxes as a consequence of these judgments. And so we would expect in this environment, I think we would expect negative capital market reactions, but interestingly, these studies came only up with very weak evidence. There, for some firms, they find some negative effects, but not for all firms, especially firms that already paid high amounts of taxes. They were rewarded, yeah? And so maybe this is the argument that the investors are happy that the firms are engaged in tax avoidance. Sometimes there's a problem with some of the structures, but they put a lot of effort, and that's good news, maybe. And my last study here I would like to present is my own. It's a study together with two co-authors from Cologne, and we consider the LuxLeaks case. It's also a transparency shock. It's a transparency shock to 300 multinational firms because one employee of PricewaterhouseCoopers took away a USB stick with the data, and then these data were published by a journalist in 2014 on one day. It was a coordinated action. And here you can see that in all European important newspapers and also in the broadcasting channels. There was a lot of discussion about these LuxLeaks, these advanced tax rulings of a big number of multinational firms in Luxembourg. And I think there was a negative type of discussion in the media. And the question is, how did the investors respond to this discussion? Yeah? What do you expect? Yeah? Taking into account all these potential consequences, we had the expectation there should be a negative effect. There would be reputational effects. And that would be a nice environment because there was low litigation risk, there were no tax payments associated with this publication. So a nice situation to identify reputational effects. Here you can clearly disentangle tax payment consequences and reputational consequences. And the result was that we find a positive cumulated abnormal return. So that's a typical method to identify capital market effects of some events. Yeah? The typical application is the CEO is fired, and then you are interested if it is a positive effect for the firm, a positive market reaction. And here we apply this technique, and we find very robust positive effects. So our result suggests that the capital market rewards firms that reduce their tax payments, and taking into account that the LuxLeaks is about advanced tax rulings, this seems to be a very smart form, a low litigation risk form of tax avoidance, and we conclude that it might be beneficial for firms to disclose at least some additional information if the multinational